In this module, I'm going to talk about one of the fastest growing investment types in the consumer or retail financial area, structured notes. They've been around for a long time in the institutional world of pension funds and college endowments, and we've been using them now for over 10 years, so we've developed quite a bit of experience with them. Here's the disclaimer that I'm doing the best I can to be accurate, but I'm not giving any advice or guarantees. To understand structured notes, it's helpful to understand where they fit in the global banking system, because they are issued by banks, but we're not talking about local community banks, on the corner. There are 29 banks that the most economically powerful nations have identified as too big to fail because they really are the global banking system. And they're grouped into 4 tiers according to their importance to the global economic system. And the most important bank is JP Morgan. Second and third most important banks are Citigroup and HSBC in no particular order. And then those are followed by several others, again, in no particular order. We use all of these banks, plus a few more that I didn't list. So in order to do banking stuff, banks need cash. And the first source in this very simplified model is deposits. All of these banks have publicly traded stock, so at some point they got money for issuing stock, and occasionally they issue more. To get even more cash, the banks borrow money in the form of bonds. So when you buy a bank's bonds, you're loaning them money, and they promise to give you interest payments for some time and then your money back at the end. But that's not the end of it. Most of these banks issue preferred stock, which pays a fixed dividend rate and really behaves more like a bond. And then there's a bunch of other forms of junior debt and subordinate debt, which I won't go into. But it's all lower in priority than the bank's bonds. Finally, there's senior debt, which is higher priority than the bank's bonds, which means it has less credit risk. On a balance sheet, all of these things are considered liabilities. If the bank runs into financial trouble, stockholders get hurt first, and bank accounts or deposits are the safest. On the other side of the balance sheet, the asset side, the bank owns buildings and land and other physical stuff. A bank will also own investments. Prior to the great financial crisis, they might have owned a bunch of risky investments, but now they mostly own relatively safe things like treasuries. Global banks are very different today than they were prior to 2008. And then we have commercial loans and mortgages and credit card debt. This is where banks make most of their money. And then all banks are required to have an account with the Federal Reserve where they keep a reserve amount. This amount's highly regulated to make sure that the bank can always pay its debts. And because the 29 banks I mentioned are so important, they're also required to have excess reserves to make sure that they're always healthy. And they get monitored, they get reviewed every year. JP Morgan is required to have the most excess reserves, followed by Citigroup and HSBC, and then after that, the rest of the 29. So structured notes fit here. They're part of the senior debt of these global, highly regulated and monitored banks that make up the global banking system. So if one of these banks ever defaults on their senior debt, we've got much larger issues, and you should probably be hiding your pets from your neighbors. Let's take a look at what a typical bank is currently paying for those things on the liability list. I just Googled JP Morgan Chase and saw that for deposits, they're paying a whopping 1/100% in interest, and they're charging you $5 for a monthly fee. Their stock pays $5 a share, and since it currently costs about $245 to buy a share of stock, that comes to a 2.02% yield. Of course, there's the potential that the stock could also go up in value or down in value. If you buy one of their bonds that expires in 4 years and you hold it the entire time, you don't have to worry much about losing any money, and you'll get paid 5.27% per year. Finally, their preferred stock shares pay a little more than bonds because they're lower in the credit priority. The last trade for the preferred shares was $25 and a penny, and it will someday get redeemed at $25, so it won't trade much different than that. Here's the difference with structured notes. If we decide to loan JP Morgan money in the form of a structured note, the terms are negotiable. So let's see how this works. Let's assume I have across the practice $10 million to invest. And we know that JP Morgan is willing to pay a little more than 5% for their bonds. For this note then, they're going to set aside the interest that they would have paid for a 5% bond over 4 years, or 20%. And they're going to go and use the other $8 million for banking stuff. The 20% is the bank's cost for using our money for 4 years, and they're pretty sure they're going to make more than 5% per year with the money from this note. So using $8 million of it for 4 years is fine. What do they do then with the leftover $2 million? Well, they're going to go use this money, along with some combination of buying and selling stock options, to create the terms that we negotiate. And I'll give you some examples of those in a second. It's a little more work for the bank to create a structured note, but ultimately it's just another form of borrowing for them that's pretty much in line with the cost of their other financing methods like bonds and preferred stock. So what kind of returns can we expect from structured notes? Well, that all depends on what we're trying to accomplish. These are just tools in the toolbox as we build a portfolio. So I'm going to use examples from notes that we use quite often today. And in this first case, I want to capture market returns, and I want to do it better than an underlying index, whether that's S&P 500 or NASDAQ. In this case, I'll use the example of the S&P 500. The way this note would work, I'd use probably a 2-year note. And if the S&P 500 is higher after that 2 years, then we would receive 1.5 times the return. That's pretty typical. If the S&P is lower, but it's higher than 80% of its original value, in other words, it hasn't fallen more than 20% in that 2 years, then we would get all of our money back. And if it's fallen more than 20%, then the bank would absorb the first 20% of loss. So let me show you how this would work with a hypothetical example. I don't care what the index does in the interim of that 2 years. I only care what it is at expiration. And if it's higher, we get 1.5 times the return. If it's up 50, we get 75%. If it's up 10, we get 15. It's completely unknown. If the index is lower, but it's not 20% lower, well, then we're still kind of happy. We get all of our money back at least. And if it's lower and it's more than 20% lower, then we're kind of sad because we lost money, but at least we beat the index. So the whole purpose of this type of a note, which we call an enhanced index, is to be better than the underlying index, and we can be better because we're letting a bank use our money for 2 years. All right, let's say I don't care about what the market does. I just want a really high probability 10% per year. This would be a different type of note. I'd probably go 5 years on this one. And the way this one would behave is that if the index is higher after the first year, we get 10%. And the note is automatically called, which means it's redeemed by the bank. They give us 100% of our money back and the note's all done, and we get a 10% return. So let's say the index goes for a year, it's up higher, we get 10%, note's all done. This is a danger year because what if the market's up 20% and we only get 10? Well, then we're kind of disappointed because we missed out on some return. If that index is not higher after the first year, then nothing happens. The note just continues to its second anniversary date where the index is checked again. If it's higher in that second year, then the note is called, and now we receive a 20% lump sum return. If it's still not higher after year 2, then it goes to the third year, just continues on. So let's use an example here where it goes maybe 3 years before it finally gets into positive territory on an anniversary date. And in that case, then we get all of our money back in a 30% return. If it makes it all the way to year 5, then what happens is we're checking to see whether the index is higher than 70% of the original value. And if that were the case, then we would receive, again, all of our money back and a 50% return. The only part where we really get into trouble is if the index is more than 30% down after 5 years. Extraordinarily rare. But in that case, we don't receive any of our lump sum returns, so we're very disappointed in that. But the bank does absorb the first 30%. So if the market was down 35%, we would lose 5. We would still have 95% of our capital to go do something else with. This is called a buffered snowball note because the downside is buffered. The bank will absorb part of the loss, and the return snowballs from year to year if we don't collect it. This last kind of note example is an income-oriented note where we receive either quarterly or monthly payments. And right now we have these anywhere in the range from a little over 8% to there's one that's 13.5%. The way that this works is it has an interest barrier. So on any day when we're due to receive that interest payment, as long as the index is above the interest barrier, we receive the payment. If it's below the interest barrier, we don't receive the payment. So it's contingent on the underlying index being above the interest barrier. On the day of expiration, and only on the day of expiration, the note will take a look at the principal barrier, which is typically lower than the interest barrier. And if it's above that principal barrier, we get all of our principal back. Again, if it's lower than the principal barrier, we get the same loss as the principal, as having invested in the underlying index. So it's not buffered. It's kind of a cliff. If we're below that principal barrier, then we have the same loss as the underlying index. We still get to keep all of our interest payments, but we lose some principal. So here's another hypothetical example. A lot of times we'll set the interest barrier at 70% of the original value, so minus 30, and the principal barrier will be at minus 40. And let's just draw in a hypothetical index. Doesn't do very well over these 5 years. And as long as the index is above that principal barrier or the interest barrier, we're going to keep receiving our payments. So if it was an 8% note, we'd be making 2% a quarter. If it was a 10% note, we'd make 2.5% a quarter. And as long as that index stays above the interest barrier, we keep making our payments. But let's say after 2 years, we hit a recession or something and it falls below that interest barrier. Well, if it's below, then we miss that payment. And let's say we miss a few of these payments. Once the index, though, gets back above the interest barrier, we would start receiving our payments again. In some cases, I might be able to build a note that has memory, in which case we would get all of our missed payments as well. In that case, the overall interest rate would probably be a little lower. Everything's a trade-off. So in this case, let's say we get all of our other interest payments up until the day of expiration, where the market takes a little bit of a dump again. But as long as it's above that principal barrier, we get 100% of our capital back. We would have missed the last interest payment, but we didn't lose any money. So that's how a contingent income note works, because the income, again, is contingent on a set of market conditions. To finish this off, I want to just highlight a few key points about structured notes. The first one is that they're not exotic. All we're doing is lending our capital as senior debt to global banks. These have been an important part of the global financial system for a long time. It's just now they're really starting to catch on within the retail or consumer space, but we've got 10 years of experience with these. And because of our scale and our relationships with the banks, we can negotiate some pretty cool terms that allow us to accomplish portfolio objectives with better trade-offs than what we can with other investments. So we can orient these for growth or high probability defined returns, high income, all these examples that I just showed. One important thing to remember, though, is that the downside protection doesn't start on day one. It develops over time. If we have 30% or 40% downside protection, we don't get the full protection until the day of expiration. So it gradually develops over time. Particularly when a note is early in its life, the daily prices, if we had to sell it early, can be just as volatile as stocks. So we really have the intent on these to hold them until expiration. One of the criticisms of structured notes from people who aren't very familiar with them is that they can be expensive, but all of the bank's costs are already priced into the terms. It doesn't have a separate expense charge like a mutual fund. All of the costs are already baked into the terms, so there's no additional fees or expense charges. Essentially, you can view them as a costless investment as long as we like the terms. Another criticism, again, from people who aren't very familiar with them, is that they're illiquid. There are some types of notes that can be illiquid. We try to avoid those. In general, I can sell a note in one account and buy it in somebody else's. That's called a cross transaction if somebody needs liquidity quickly. We can do that, or the banks will redeem these at any time. Again, because the prices can move around, they might be higher, they might be lower, so we don't know until the day of expiration what the final price will be. But they can be redeemed back to the bank at any time. All right, that does it for structured notes. Hopefully you found that informative, and be happy to answer questions if you have them.